Alpha here, and today I'm going to talk about the reasons why business need funding, business need debt, and most common misconceptions. So I'm going to talk about the common misconceptions about debt funding. So skipping all this part, the big problem is that there's a lot of money in the banking sector. The funding gap is huge, and you have like gazillions of banks sitting in this island of all money. It's really hard to get there. So there's money. Banks have very good loans to deposit ratios. They have equity to lend. So the statistics are in favor of lending, and there are very high rejection rates. And because of that, founders think that it's not good to go for a bank financing. But today I will show you why it's much better to use debt as a growth, as a fuel. So narrowing down to the Europe, I like this map. It shows you don't know where to look for money. So sometimes you need to borrow locally, but sometimes it's worth going international and fundraising there. So again, banks hold very good LTD ratios, and for 2025, the interest rates are kind of going down. I know it'll happen in the future, but then still, some SMEs I know, some owners of the companies that have the old interest rates and contracts, and banks are tricky on that. There are billions of euros untapped, untouched, sitting in the balance sheets of the banks ready to be lent, but they're not taking for the founders, and we're lagging behind US. So in US, the average citizen and the average household and business borrows more money to their asset worth than we do in Europe. So this is something to consider. This is the statistics, and it doesn't lie. So these are the places I can actually have my money to grow the company. So this is something that most of the founders, they understand. Then one is the revenue. Like, you need to generate more money, and you know how. You call more customers, you do more sales. If unit economics are positive, you do more revenue. If the unit economics are negative, you do more cash flow, but you sell with a minus, but at least you have more money in the account. Then you optimize working capital. You work with your debtors, creditors, suppliers. I mean, you have all this mix. Then, of course, you can restructure liabilities. You borrow money from like friends, family, fools, or you borrow from banks, alternatives, and then you have the equity investment. But again, most of the startups, they go for equity investment. They forget about revenue. They spend 5-7 years time working the product, and then nothing happens. So this is the technical capital ladder, the framework I like to use. Well, you start with your own money. You start with your own capital. You start with your own, ideas and thoughts and product, and as much as possible, you invest that, keeping equity to yourself, of course. Then at some point, you can add to the mix a local, international bank and non-bank lenders. Then you go for government EU programs, longer, but you don't. They're much cheaper and don't require any capital. Then you go to alternative private credit, and then of course there are like bigger, more international lenders available out there, and then there are equity partners, private equity, VCs, high net worth, you name it. So again, we're talking about the against the odds. So the odds are stacked against us entrepreneurs. This is something we need to consider. So there are many things that could go wrong, and they do. Look, I found the 30 plus companies. Some of them I closed, some of them went bankrupt technically, no money account, we just closed them. Some of the projects I sold, some of the projects are still going on. So it all depends, and there are many factors that are making an impact to this business. So there are many reasons. Actually, for that you can go and look for startup autopsy, and they have a lot of statistics why companies go bankrupt. I think it's one of the more one of those resources where you can really it collects data on companies when they go bankrupt. Most of the founders don't want to do that, but there are some crazy that are ready to submit some forms and run interviews and to share their knowledge, because I think it's very important to share our knowledge to the forthcoming entrepreneurs, to the new generation. But again, there are many reasons. The top reason is there's out of the money. So there's no money on the bank account. The revenue that's going in. I was there. I think most of you who are watching this, either you have business or you plan to have a business. Most probably in your life, you've been there in a situation where you have like zero money in the account, or you have like not much, or you have something and you already that tomorrow you will spend it. So practically means zero. So it's a technical reason. It's actually a trigger, to go into liquidation of the company. I mean, if you don't have any liabilities, having zero at the account is okay, but you have liabilities and you can't pay them, then there's a problem. So the number one reason companies go out of business is no customer, no money, and there's no customers, and there's a poor team. These are top three. I work with out of the money question. I don't work with no customers, poor team. This is not my area of expertise. I know what means there's no money in the account, and I know how to solve it with the help of debt funding that we're going to talk about. So why would we need money? This is something most of the no, I think we just forget as business owners and then founders and CEOs and CFOs that we need money. Money is a liquidity, and it's the resource for marketing and sales. So we can hire more people in that team. We can spend more money on ads, given that our LTV to CAC ratio is good, given that our unit economics are positive, given that we know how the funnel works and how to get more customers. We need more money to get more customers. You pay that first, and then you get them later. Then we need money for the working capital. It could be purchasing equipment, purchasing, some goods and services in order to provide my goods and services to the companies and customers. So we need money actually, and maybe not today, but we need it in 1 month or 3 months, and I need to plan it today. Then we need to hire the best team. The best people, they cost a lot. So they cost more than average or C players. So therefore, we need to have money to hire them. And then we need money for growth and expansion to grow the company, to grow business, because with a higher business, actually, it's much easier to get better rates in banks. It's much easier to, with a bulk, buy more at a cheaper price at a discount. It's easier to go to customers that are buying only from starting from a certain amount of the service or products you can deliver them. So actually, there's a win-win situation when you take the money, grow the company, and because of that, you get into the niche, into the distribution chains where you otherwise could have gone without that size, right? Then you invest in capex, capital expenditure, equipment, technology, R&D, inventory, to stack up inventory, to refinance expensive debt. Remember that, George, you take money from it like 25% per year. Well, you need to refinance that today, right? So you take cheaper money to give back more expensive money. Then you can buy companies. A big guys, what they do, they buy companies. This is what I heard. Like billionaires don't, they don't run the companies. If they find a good fit, they buy it, they scale it, and they sell it. Then you invest in real estate, you invest in R&D, product development, and you have always a liquidity buffer. It's always good to have some cash for different situations and for different purposes. And again, debt is everywhere. This is what I daily speaking with the founders. This is what I see. Like, yeah, but my case is different. Yeah, but in this country is different. Yeah, but I mean, so bullshit. We all have the same situation. The math works for us the same. And look at the big guys. I mean, the big guys, they're running the debt. You can't go to the public markets. This is my vision, without raising debt financing, because it increases return on equity. And those investors in equity, they want to have higher return on equity, right? So they will force actually to go to a bank and get a bank loan at some stage. it, let's flip it. You are an investor, you have a company, you see that it's unleveraged and it's not using, every cent on a penny. So what you will do, most probably you will invest equity and make them to go for a bank to increase their liquidity, to have more revenue, to have more profit. Again, it's a math problem. That is a math problem. Some people emotionally are scared of that. I think it's because they're fog in their brain. Fear lives in the fog, growth in the clarity. And I see money as a pile of money in the chest. When there's a fog, we are scared of that. We are fearful of that. Why? Because we are emotionally bound to it. But when we open our eyes and we see that actually there's a chest with the money, what's the money? It's debt. Why? Because if mathematically speaking, you need to be using debt to grow the company. So if you're not, let's make a math here. So let's say you have an equity and you have assets and you have revenue, gross margin 20%. There's one cycle. Let's say for sake of example, in 1 year you do one cycle of this business of the transaction. You take a bank loan, 1 million euros, 2:1 debt equity ratio, and it's for 5 years, 5% APR, annualized percentage rate, including all the fees and commissions. So the question is, should you borrow? Well, the thing is that keeping other things fixed, you need to borrow. Why? Because mathematically, you take money at 5% and you earn 20% gross margin, right? So it's 15% for one cycle. If you have two cycles, it's even more. So, and let the numbers speak. With the same example, we borrow, and what we see, there's change. Return on capital employed increased by 38% by borrowing money. Revenue increase, pre-tax profit decreased by 38%, right? So it's worth doing that, right? If margin is higher than interest, of course, we'll not go into a situation where it's not okay to borrow, or sometimes you borrow even if margin is lower than interest rate, because you want to get to higher deal, you want to get to the new level, or you want to grow to reach some numbers, and then you refinance the expensive debt with a much cheaper one. So where are you in the capital map? So this is something specific. We done it. This is our real knowledge put it on the map. This is a very unique framework. You will never see it anywhere. Any bank will not show you this because they don't use that. Only brokers do that. So given our knowledge, there's an axis on X, there's not available capital, and on Y we have capital is needed or not needed. So again, you can think where you are right now. I'll start block by block. So if the capital is not needed and it's not available, it means that the park's potential. From founder's perspective, there's low urgency, you're dreaming about something, but nothing's really happening. And again, from a financing perspective, they have nothing to finance. They have no project which they can submit, no asset to pledge, no revenue to use. So no story to share, right? So these guys need to think of on the numbers, on the story, and the business to start running. Then we have guys who need capital, but it's not available to them. Why? But mostly there are some reasons. We're going to talk about in other videos about what are the top reasons why companies are stuck. But majority of them are stuck because their balance sheet is not right, their metrics are not right, their assets are not there, valuation is not good, maybe the margins, maybe tax debt. There's always something to be improved, right? So if you're stuck there, no problems, don't worry. We can help that. Or you can do that with your accountant, with your CFO in-house. You know the homework that needs to be done. Actually, this is what I found quite intriguing. The most of the founders we talk to, they really know what to do. Then the question is, what's the priority? So my job is to make this for you more priority. Then we have rich and calm guys. They're rich, they're calm, no hungry, I'm good, I have this equity, I have this revenue, I'm good. Okay. So for these guys, there's a lot of capital to be used to grow their company, but they're kind of rejecting for many different reasons. And then there's armed and hungry. So these guys, they need money, the money is available to them. Usually we work with these type of customers because it's much easier, because they know what they want, they know the numbers. Why they work with us? Because time is very precious. They don't want to spend much time on raising capital because they're focused on other areas of the business while we are helping with them. Even though they have team accountants, CFOs in-house, we work as a team because there's a lot of things to be done and we need that CFO in-house. So just ask yourself a question where you are on this map. This is that I borrowed honestly from Ty Lopez, not but Tony Robbins, and Tony Robbins said, "Well, we all have six specific, needs." And what I thought that capital actually is, in the middle. So with the capital, you can have more certainty, to have more liquidity buffer. With the capital, you can have more variety, right? You can have more variety of options, what to do, where to invest, whom to hire, what to do. With the capital, you can have more significance. You have more credibility, better credit scores. With that, you can borrow much cheaper. You fundraise easier. Investors know you. With more capital, have more connections, more loyalty to different partners. To suppliers, to customers, etc. To partners. You have more growth with that scale. More money you can easily scale and go for the new horizons, and you have more contribution. You can actually make better products, better services, have a bigger impact and a contribution to the society. Okay, so on this note, I'll finish. Thanks for watching, and let me know what you think about that. Write your comments and subscribe and like and share with the founders, with owners of the companies, with SMEs around the world who are, you know, who are working their ass off, because in the world there are 600 million entrepreneurs who are running 300 million SMEs. They have like half of the GDP. They employ two-thirds of the population around the world, and out of them every day around 60,000 SMEs they go bankrupt. So share this with your friend, with your founder, and most probably to stick with it, because this is what I know from my experience of 15 years of fundraising and business lending and entrepreneurship. Thank you very much for watching. Have a nice day.